Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill. After this program, we'll have a new name, a new nom de plume. No, that's not right because it's not written. Okay, a new nom de guerre. Oh, wrong again. We're peaceful. We're not at war. What we're going to have is a nom de web, Financial Poise Radio. In a few moments, we'll be talking about food, about agriculture technology with Philippe de Lapérouse, Managing Director of HighQuest Partners. We've had him on the show before, but the topic, food, agriculture, ag tech, is certainly worth exploring again and again. After all, getting us fed is our earliest preoccupation as a species, and remains one. It's with us still. Its principal charm for me is that getting us fed is a decidedly non-virtual reality. It presents us with a host of problems and a host of opportunities. Well, let's talk a little bit, since we're talking about food and eating, let's talk about jaws, new jaws made of titanium by a 3D printer. We've had jaws made of various things for people with jaw afflictions, but a 3D printer presents certain advantages. So we turn to www.3ders.com. It's a website for 3D printers and 3D printing news. And in its April 13, 2016 edition, there's an article about a cancer patient in Israel. A 64-year-old Israeli cancer patient receives 3D printed jaw implant. Okay, it's going to be a good story, but first, we talked before on this program about 3D printers and what they've been able to do. One example we talked about was a bridge in Holland over a canal built entirely by a 3D printer, a metal bridge. You turn the thing on, and a little while later, you have a bridge. 3D printers have also reputedly built an automobile. I don't know if I really buy that, but maybe they have. Certainly they will. We even joked on the show about 3D printers being capable of making 3D printers, replicating themselves, like the proliferating brooms in A Sorcerer's Apprentice from the 1940s Disney movie Fantasia. Music conducted by Leopold Stokowski, memorably with the Philadelphia Orchestra, the music composed by Paul Dukas in 1897, based upon a Johann Wolfgang von Goethe poem in 1797, The Sorcerer's Apprentice. So Goethe wrote at the dawn of the Industrial Revolution. Dukas wrote at the dawn of the modernist response to the Industrial Revolution. And now we have 3D printers potentially making 3D printers and revolutionizing manufacture all over again. But while you're chewing on that makeshift intellectual construct, let's go back to those jaws, that specific jaw built for that suffering man in Israel. There was cancer found at the back of his jaw, a large metastatic tumor. You got to get rid of those. And to do that would mean destroying part of the jaw. Could maybe kill what other cancer is in there through radiation and chemotherapy. But what about the jaw? What about functionality and comfort after you've saved the man's life? Existing pre-3D titanium printed jaws often wouldn't match up quite right, and chewing would be laborious or difficult or painful, and could even result in the breaking of the jaw. Well, the medical center partnered with AB Dental, an Israeli 3D printing company, in an earlier case to rebuild an injured Syrian man's face. That story is linked to this story. And what they were able to do because of 3D printing is create an exact, in terms of shape, titanium replica of the healthy jaw. It was implanted with no complications. Instead of taking 6 hours, the surgery took 2 hours. His facial appearance wasn't altered in any way. There was no adjustment that needed to be made to the patient's chewing. It fit right in there and functioned the same way. This to me is a great triumph. This is the first time this was done in Israel, but it's not the first in the world. The article reports that 3D printed prosthetic jaw implants have saved the lives of patients in Australia, India, South Africa, and China. So the wonders of technology and the portent of technological and manufacturing transformation to come. Well, let's turn from that to the useful reminder department. If you've been listening to this program or reading attentively the better writers on investing, you'll know that active managers who run the fancier funds out there can be measured. Their performance can be measured against an index that represents the market as a whole. Obviously, if you're paying a 1 or 2% fee to an active manager or more, the performance of the financial instruments so managed must not only beat the market, they must beat the market by more than the amount of the fee. And that is an appropriate question to ask. And that is one of the 2 insights I'd like to remind us of. It is appropriate to measure active managers against the performance of market indexes. The second important thing to bear in mind is to buy low and sell high. We all know these things, but they bear repeating. And they were repeated in a couple of places. Pension and Investments Digest, March 21, 2016, article by Sophie Baker, brought to light a study done by S&P Dow Jones Indices of the performance of Euro-dominated active emerging markets equity strategies, comparing them to the S&P International Finance Corp's composite indices over 10 years, 5 years, and 3 years, going back in time. So looking over the last 10 years, those active managers underperformed the composite indexes and underperformed the market to the tune of 97% of them. That is, almost all of them underperformed the market. Over 5 years, 89% underperformed the market. Over 3 years, 82%, and over 1 year, 74.9%. Okay, so you hear promises from active managers. You should try to ask the right question, which is how do they measure against market indexes? But maybe that's not the only question to ask. Well, you'll note from the statistics I just gave you that over the 10-year period, nearly all managers underperformed. Over 5 years, a slightly smaller percentage underperformed, 90%. For 3 years, 82, over 1 year, 74. So comparatively, even though still not great, over the last year, active managers were able to defeat the market indices at a little higher rate than over the last 10 years. So what's been happening over the last 10 years? Well, to understand that dynamic, we turn to a completely unrelated article from the Wall Street Journal. Jason Zweig, the author of The Devil's Financial Dictionary, a book I simply must read, and he was the intelligent investor columnist for the Wall Street Journal. In January 28, 2016, wrote about lessons from a frontier market, the United States. The United States was an emerging market for much of its history. Studies have been done of how the emerging market played out over much of U.S. history, and this can be applied to emerging markets today. And when we get to the summation of the article, we find the following writing that I will read. A study of more than a century's worth of investment returns shows that emerging markets deliver their best results not when hopes are highest, but after they break investors' hearts. So they don't deliver their best results when hopes are highest, in other words, when prices are highest, but they do after they break investors' hearts, in other words, when prices are lowest. Buy low, sell high. Then he brings the data into the present. I'm reading. Emerging markets handed investors a 30% loss in 2000, but then doubled in the decade of the 2000s, even as developed markets went down. Okay, so emerging markets did well from 2000 to about 2010. So from about 16 years ago to about 6 years ago. After that, their popularity peaked in 2010, and the 5 years since, emerging markets have lost a cumulative 22%. Maybe the reason why the S&P Dow Jones indices found that active managers have so rarely defeated market performance in general over the last 10 years is because that period began when hopes were highest for emerging markets. It began at the close of a 10-year run in the late aughts or the late 2000s of outsized emerging market performance. So having begun there over the last 10 years, it's no surprise that over the most recent 10 years, almost all active managers managing emerging markets equities have underperformed the market. And the market is in the doldrums. Perhaps it's at the low now or nearing the low or within range of the low. Perhaps now's the time to buy. Perhaps you're buying low after the market has broken investors' hearts at this time, or maybe it's not quite time yet. At any rate, to reiterate, measure active investor performance against market indices, against market performance in general, and you should buy low and sell high. Having said those two things, you need to know a good deal more about whether you're buying low and when it's low and when it's high and so forth. So we can leave that for another time. Let's now turn to our guest. We have here with us Philippe de Lapérouse. We have him on for the second time. We're lucky. He has over 30 years of senior management experience working across the food and agricultural sector supply chain globally. De Lapérouse began his career in investment banking and comes from a family which has generations of experience farming in France. As managing director of HighQuest Partners, Philippe has led over 50 engagements advising executive teams of major strategic and financial investors operating globally across the food, biotech, and bioenergy value chains. He helps them make informed decisions regarding resource allocations, new business opportunities, and investment strategies. Philippe serves on the advisory committee of the Ag Innovation Showcase at the Danforth Plant Science Center in St. Louis, Missouri, and is the author of the report entitled Private Financial Sector Investment in Farmland and Agricultural Infrastructure, which was commissioned by the Organization of Economic Cooperation and Development, otherwise known as the OECD, in 2010 to provide insights on these emerging asset classes and the impact that private sector investment is having region by region. He received his Bachelor of Arts from Trinity College and an M.B.A. from the Darden School of Business at the University of Virginia. Good to have you with us, Philippe, to talk global agriculture.
Nice to be back speaking with you again, Chris.
All right, so remind us, what is HighQuest Group or HighQuest Partners, and how is it involved in the agricultural and financial sectors?
Sure. Well, I mean, HighQuest Group is has three different businesses: strategy advisory, which works with corporate or strategic investors as well as financial investors, institutional investors that are either operating in or allocating capital to the global food and agricultural supply chain. And we work with clients around the globe on different projects related to resource allocation in the sector, strategy and resource allocation, and different issues that those players face as they try to expand their exposure in the food and ag sectors. We have a conference business, an events business that is organized to bring together players in the value chain, both investors as well as participants who are active along the supply chain. And we hold various conferences around the globe annually to address those issues. And we also have a media business that publishes and provides information for those industry participants.
All right, well, let's go to the conference portion of the HighQuest Group portfolio, because you have a very important conference coming up. It's called Global Ag Investing 2016. It's in New York April 25 through 28, 2016. I think a lot of people, when they hear about a business conference, they think junket. It's just a way to get your employer to pay for drinks and food and so forth. I have to think that this one has a lot of substance. Are there a lot of people involved, and what kinds of substantive things take place?
I would hope that people wouldn't view this conference as a junket. I don't think they do because of the cost involved. So fair as a registration, it's not inexpensive to participate. But the reason for that is because it is quite dense in terms of both the agenda, the topics that are addressed at the conference, and also because of the networking opportunities that this gathering provides for industry players to get together. The upcoming event we have in New York, starting next Monday, is our flagship event for our Global Ag Investing Conference Series, which convenes both institutional investors, which would include high net worth individuals, family offices, pension funds, endowments, university endowments, insurance companies, hedge funds, and sovereign wealth funds, and multilateral lending organizations, together with asset managers that are actually involved in the space. And in specific asset managers that are focused on managing investments that are made all along the food and the global food and agricultural value chain. And so we'll have 4 days of events. We start midday on Monday with a short course, which is a primer for those investors that are coming and looking at ag as a alternative, a new asset class to get them up to speed. The next 2 days are a series of plenary and track sessions addressing different opportunities and challenges for allocating capital in the agricultural value chain. So looking at investment in cropland, in infrastructure, animal protein production, agriculture, the impact of water and what one needs to know about water when one is investing in different regions of the world, opportunities for investing in infrastructure. And that takes place for 2 days. And then on the fourth day, we have an event which is a continuum, if you will, of the previous 3 days, though some of the attendees of the previous 3 days don't stay on. And that's focused purely on ag tech. And so with looking at different opportunities and challenges for investors that are looking to invest in ag tech, typically, but not exclusively, but typically that will attract the venture capital community. So a lot of it is early stage, though a lot of the investment opportunities in ag tech are not necessarily early stage because they're either pre-commercialization or in some cases companies are already actively commercializing their product to the marketplace. So this event that we have in New York is our flagship event. We conduct similar conferences with somewhat of a different agenda and focus. In June, we'll have our Ag Tech Week in San Francisco, which is focused on ag tech and, again, looking at the venture capital community out in Silicon Valley. And then next fall, September, second week of September, we have our Asian event, which will be held this year in Tokyo. It will be our 6th year in Asia. Previous 5 years, we held that event in Singapore, and we're shifting to Tokyo because of indications that the Japanese government is trying to promote more aggressive investing on the part of Japanese financial institutions globally, including in agriculture. And then we do our London event at the beginning of December, and we're not sure what we're going to do again in the Middle East next year, but we may do an event in India. We're still considering that. And so these are venues and events that we hold annually in all these regions each year.
Yeah, so if you missed it, you have a chance here.
Yes, I mean, one would have a chance next year. The New York event tends to be the bigger event. We attract somewhere in the neighborhood plus or minus 750 people. It's held at the Waldorf Astoria, so it's Midtown. There's a lot of very high energy networking in between the sessions. So for people in the industry, it's really a convenient and effective way to see one's peers, but also for those looking, particularly investors, qualified investors who are thinking about allocating into the sector, it's a very good way for them really to get their feet wet.
Well, it sounds like, to borrow a metaphor, the equities market is a market for price information. This sounds like a fantastic market for innovation, information, and
yes, yeah, and I should emphasize too for those listening. I mean, these are not company. Obviously, people attending and presenting represent funds or companies that are looking to raise capital or looking for strategic partners. But we're very strict about making sure that in none of our sessions are people allowed to make company pitches. In other words, the people participating in these sessions are addressing issues related to opportunities and challenges relating to the industry. And, of course, their credibility and their experience is what we're hoping they'll bring to bear in terms of sharing their insights as to what's occurring in the marketplace. So it's not a series of company pitches, shape or form. I mean, we really make sure that that's not the case. So it's a very dense. I mean, people are tired at the end of this event because there's so much shared in terms of information, perspectives on what's going on in the marketplace. And we also like to make sure that some of the presenters are provocative in terms of sharing differing viewpoints on what's actually going out there. So it's not cheerleading the agricultural as an emerging asset class. We're very upfront about looking at what all the challenges are, and so that people attending it really get a firm grasp of what's occurring in the market.
Okay, well, let's talk about one of those challenges. It's a front page of the business sections. Gas, oil, and steel to varying degrees are disastrous stories of commodities. And agricultural commodities are commodities too. Are they doing less well or better in general than gas, oil, and steel? And why might that differential, or how might that differential be explained?
Well, first, I think all commodities have suffered, including what you were referring to, oil and gas or oil and minerals, which one would refer to as hard commodities, and then the ag commodities, which one would refer to as the softs. And they've all suffered, because of the deceleration in the growth in China. Demand in China has abated. And not only in China, but China's the big story, but I mean, we see this around the world. Interestingly, we think that India eventually could replace China as a big story in terms of demand for some of these commodities. But there's no doubt that the soft commodities have suffered a similar drop in prices, though not a reversion to historic means by any argument. I mean, it's I think the average price of corn was $175 as recently as 2005. So, I mean, corn prices are still well above the average mean, historical mean going back over 2 decades. So the commodities, soft commodities, crop commodities have suffered, though I would argue that I think they are different. And some of that has to do with the fact that some of these commodities are also produced using energy, and we, for a long time, forgot to think of the nexus between energy and crops and food, but which exists really for most things out there in the marketplace today. But energy is obviously a component of the cost structure of food in terms of transportation fuel used to get the products to the field to plant it, and then the crops at harvest to the consumption markets. But also energy was used to produce fertilizer, which is a key ingredient for row crops or for production of soft commodities. So we have seen, retracement in prices, though I would argue that there is a difference between soft commodities and hard commodities in the sense that governments are going to be loath, and I refer to China and other, governments around the world, are going to be loath to put their increasingly urbanized and growing middle classes living in urban areas. Because of political concerns and political risks, they're going to be loath to have inventory disruptions in the availability of quality, healthy foods to eat for those populations. And in many cases, such as China, they're dependent on certain crops on imports, particularly for fodder crops for growing animal protein. So I think there is a difference between soft commodities, which are necessary for sustenance for populations, versus hard commodities, where one can forego a car or an apartment, or and of course we've seen in China the overbuild in the real estate market. So I think there is a distinction to be made between the two.
Okay, so agricultural commodity prices have been retrenching, while in recent years, especially in the U.S., but perhaps elsewhere, agricultural land or farmland has been a great source of gains for investors.
Mm-hmm. Right.
So if agricultural commodity prices affected the prices for farmland, do they typically march in lockstep, or is there a lag? I mean, how does one understand the relationship?
Well, there certainly has been a kind of, I wouldn't say a fevered pitch, but there certainly was a great deal of pressure, a great deal of interest investing in farmland. If you take, and it's important to point out that farmland and farmland prices is a very local market. I mean, it's very local. The value of land, whether it's for free title to own land outright or for long-term lease, is very dependent on not only the region but also the quality of the land, its location, and and the yields that one can generate off that land. And that tends to be very variable and very local. There was, tremendous interest in farmland here in the U.S. when, people were making quite considerable, were getting in, buying low and selling high. There was some flipping going on in the mid 2000s. People getting in very early and then flipping and achieving some very impressive returns over a 2 or 3 year period. But I would argue that that's not really where the opportunity is, and that always attracts attention of the media. But farmland, if viewed along similarly to timberland, is a long-serving asset. If properly nurtured, should be an asset that continues to generate a return. Farmland is referred to often as gold with a coupon. So if you're maintaining the soil and the land, and you're constantly maintaining or developing the land or bringing land into development so that it improves its productivity, that's an asset that should hold for 20, 30, 100 years. So that in itself represents an opportunity for investors for diversification of their portfolio to enhance the overall return on their portfolio by having exposure in this asset class. It preserves wealth. It can't travel. It can't move. I mean, if you have free title or you have a long-term lease, you have either total free ownership of that land or you have use of that land for the term of your lease. So the returns from land and from agricultural production are typically counter-cyclical with other financial instruments. It has a negative correlation with those other instruments. And it's an asset that generates not only a current return, which is the coupon, which I was referring to as gold without coupon, but also a long-term appreciation in the value of that land. So I think while some, investors in the, let's say, mid-2000s were early into the market and maybe made 25% per year per annum over a 3-year period and flipped some land, that's not going to happen all the time, and that's not happening now. But one could earn a 2 or 3% annual return on the income generated on that land, and over time a 6 to 7, 8% capital appreciation over that 25, 30-year period. That's an attractive return for an investor, given alternatives.
So let's turn then to something that may have less play in the Global Ag Investing conferences coming up this week,
right? Mm-hmm.
And more in your Japan conference that's coming up or other Asian conferences, and that has to do with Chinese investments in agriculture. It's known that there are lots of people, even now, there's lots of capital in China waiting to be deployed. There are capital controls and so on, but there are also Chinese corporations, perhaps at the direction of the government, which are aggressively investing. And sometimes in agriculture, my understanding is that Australian agriculture has been a particular target of Chinese investment. I was wondering if you could comment on the scale and significance of that, whether the Chinese are investing similarly elsewhere besides Australia. You just go ahead on that.
We've seen within this quarter, the first quarter of this year, and the end of the last quarter of last year, 2015, a surge of investment transactions of announced the Chinese investments in Australian agriculture. And there's a very good reason for that. It's location. I mean, just look at the map. Australia is perfectly situated to supply the South Asian and East Asian markets with commodities, both animal protein, aquaculture, and crops, both fodder crops for animal protein production, as well as other crops for human consumption, and as well as permanent crops, things such as almonds, fruits, vegetables, that sort of thing. So it's a perfect opportunity for us. It makes eminent sense for the Chinese and for the Australians to be collaborating in this regard, both Australians making investments in China to create opportunities for exports, as well as Chinese capital coming into Australia to invest in operations and improve land development and bring investment that's needed to further develop Australian agriculture. So we've seen a string of large investment. For instance, Chinese Resources acquired a 15% stake in the largest apple export in New Zealand. We've seen, Chinese Moon Lake received approval from the Foreign Investment Review Board in Australia to invest in Tasmanian land. It was the first deal that the Foreign Investment Review Board in Australia approved based on Chinese buyers agreeing to comply with new tax regulations in Australia. Not in Australia, but we saw China bid and pay $43 billion, most of it in cash, to acquire Syngenta, kind of competing with Monsanto for that asset. We've seen the Costa Group, which is a big fruit and vegetable producer in Australia, and Driscoll's announced a joint deal. Well, that's an Australian group, and Driscoll's out of the U.S., the raspberry and strawberry producer going into partnering in berry production in China. So that's going the other way, But there's China insurance company agreed to buy a grain farm for $24 million. So there have been a string of announcements over the last quarter, and we think that's going to continue for some time to come.
You did not mention Tasmanian Scotch. It's come to my attention that it's some of the best Scotch in the world, and I was just wondering if the Chinese
really? Well, I have to take a look at that.
Too.
I enjoy drinking Scotch. I like Suntory Scotch, which is Japanese. That's very good Scotch as well.
Well, maybe this is something that will come to light in the after hours after the Global Aginvesting Conference meetings, where the networking is good heavy.
We'll have to remember that next year we do to entice people to attend our London conference, which takes place the first week of December. We usually have a whiskey tasting at the conclusion of that event, so we'll have to see that we add some Tasmanian Scotch there.
Well, if you need a moderator for the Tasmanian Scotch panel at next year's Aginvesting, I hereby volunteer myself.
Okay, well, great.
Well, speaking of Australia makes one think of many things, and one of them is something you alluded to earlier, which is water. In other words, the absence of it. Australia is not crazy rich in water. Lots of places in the world are short of water or experiencing drought. So is there a story in connection with Australian agriculture and drought, and what can be said about water shortages and the outlook for agricultural investment worldwide?
Well, so water, when you think about agriculture, really what agriculture is it's a trade in virtual water, whether it's buying vegetables here in the Midwest that are grown in California, or particularly crops that are exported out from the U.S. or Brazil or Argentina to other locations in the world, or Smithfield hams going to China from the U.S. All of those commodities being exported are basically you're producing a product where there's an ample supply of water to a place that's short of water and values that, it can't produce, or it's too costly to produce that commodity in that location. So water is key. Water plays a very important factor in Australia. Well, it's important everywhere in the world, but it's extremely important in Australia because they are prone to suffering cycles of very severe droughts. They have to husband their water resources very carefully, which means that the Australians have really, along with the Israelis, are really the world-leading experts on how to manage water resources efficiently in agriculture, and have developed some unique techniques, financial tools for managing that, and a regulatory environment for managing the use of water, both surface water as well as groundwater. What we see is the Australians bringing and transferring that know-how and management know-how and technology, if you will, into the California market right now, helping Californians develop some financial risk management tools that can help the state better manage its water resources. And specifically as it relates to Australia, that is true that depending on where one's operating, because Australia is a continent in and of itself, so they're vastly differing situations depending on where you're operating. But where water is in short supply and where you're cropping and grazing, one has to be very careful when undertaking due diligence to understand what that situation is. And so you're really managing three risks when you're investing in a lot of places in Australia. It's a mix of grazing, cropping, and also understanding the water situation. The water looms as a far more, and it will, I think we see that coming to the North America as well and other parts of the world, but they're further along the learning curve than we are in Australia.
Well, does this mean that the Ag Investing 2016 conference in New York, there will be Aussies and Israelis bringing light to this subject?
Yes, we will be there'll be sessions addressing the opportunities for investment in Australia, both in cropping for animal protein production as well as permanent crops. And we'll have participants on the on the podium, experts who have experience dealing with that. And we see a lot of transfer. That's the other interesting aspect of this conference series, is that there is a lot of transfer of know-how, management expertise, and technology that takes place because of sharing insights. And so we see different strategies that operators in the field are using in different parts of the world and transferring them to other places where they see opportunities to improve productivity.
Well, the culmination of the conference is the fourth day, which is devoted to ag tech. So why don't we let that be the culmination of this interview? Can you comment a little bit on what's new with ag tech as it manifests itself at the upcoming conference?
Well, I don't know that there's any. We have new companies, we have new players. We have one company that will be participating that's one of the few that actually exited, or the liquidity event was an IPO, an initial public offering, as opposed to a strategic sale, which was quite interesting. An Israeli company called Evogen. We'll have some business cases to kind of show people different models that entrepreneurs have used to both raise capital as well as to push their companies on towards a liquidity event. I don't know that there's anything too new other than, there continues to be a discussion about how to best bring some of these new technologies and new ways of operating to the marketplace, both for precision ag as well as big data. That's still the big question, is what that value can big data bring to operators in the field that repeatable and observable and can be actually measured. And so what is interesting is that for the second year in a row, 2015, 2014, there was somewhere over $2.5 billion invested in early stage ag tech, which would include novel food ingredient technologies, so food and ag tech, ag production. Last year, it was over $4 billion. So an increase, almost a doubling in terms of capital allocated to the sector, and a doubling of the number of investor organizations involved. So I think there is quite a bit of interest in this area. One area, I take that back, one area that will be featured a bit more is indoor agriculture this year. That is the production of leafy vegetables, as an example, lettuce and leafy greens, indoor facilities located close to consumption markets. We see this taking place in New England and Boston, outside of Boston, and the New York metropolitan area, and some other large cities in the U.S. and Chicago, where entrepreneurs are developing sites to produce leafy vegetables. So you improve you reduce the cost because you're producing it local, close to where it's consumed, but you're also increasing we're decreasing the liability or the possibility of having pathogens in the supply chain, because you're controlling it. You have a lot more control over the production and the whole process. That's something that is new. That is something that we saw looming in the horizon over 2 years ago, but I think we're starting to see some projects, actually come off the drawing boards and go into production. But I think that's exciting.
Well, Philippe de Lapérouse, you have talked about substance, which is apparently the core of the experience at the Global Aginvesting Conference that's coming up in New York, April 25th through 28th, which is fitting for something like agriculture worldwide. There's a plenitude of opportunity in agricultural production, distribution, technology, and of course, investment. And we really appreciate you introducing us to some of the important topics today.
Well, I enjoyed speaking with you again, Chris, and look forward to doing so again in the future.
This has been Accredited Investor Markets Radio. Accredited Investor Markets Radio is produced by Stephanie Strait. You can find this podcast and others like it at www.accreditedinvestormarkets.com. Thank you all for listening, and let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.